Here in Chapter 11, we're going to cover a topic called S corporations, which is really a combination of the C-type corporations we had learned uh, 2 or 3 chapters ago, and also partnerships that we had just learned in the last chapter, the last couple chapters. So this S really stands for sub-chapter S. The C type corporation is sub-chapter C. And partnerships, even though you don't hear it a lot, is really sub-chapter K. All of these sub-chapters are, I guess, a sub-chapter of the main chapter, I guess chapter 1 of the Internal Revenue Code, where all the detailed laws are located. But to make it specific, whether we're talking about an S type or a C type, we identify it by the letter S. And if we don't say S or C, usually we're going to default to C, like we saw in, again, the past chapters. So in this chapter 11, we're focusing on S-type corporations. So let's get an overview of how these 3 types of business entities compare with each other. So in our textbook, I guess back in chapter 4, and also here in the end of chapter 11, you'll see this table which has multiple slides that compares the 3 types. Again, the S here in chapter 11, C 2 or 3 chapters ago, and partnerships our last couple chapters. And it gives you about a dozen different attributes or characteristics differences. And the main ones I want to focus on here is that with a S-type corporation and a partnership or limited liability company treated as a partnership, the main advantage here over the C-type corporation is the avoidance of double taxation. In other words, the S-type corporation and partnerships and limited liability companies are usually not subject to income tax. We may see some exceptions at the end of this chapter 11, but generally they don't pay income taxes. Whereas a C-type corporation is subject to income tax. Though, of course, the way we avoid taxes for S and for S-type and for partnerships is that we pass through the income and the losses or expenses down to the owners, the S corporation shareholders, or the partners in a partnership, or members of a limited liability company. They pay the tax on the entity's income, whereas the C corporation itself pays income taxes. But then if there's excess profits that we want to distribute to the C corporation shareholders, that's going to be treated usually as a taxable dividend to those shareholders. Now, if you pay a dividend to an S corporation shareholder, usually that dividend is tax-free. Again, there's exception to that, but that is going to avoid the double taxation if the distribution is tax-free to the S corporation shareholders. Likewise, withdrawals or distributions to a partner of a partnership or member of a limited liability company, generally those are also tax-free, again avoiding the double taxation. Okay, so you can see the advantage here for S corporations and partnerships. Now, maybe another thing that we want to do is avoid paying taxes upon the liquidation of a business. We saw back in the corporate chapter and also now in the S corporation chapter, if you liquidate a corporation, you may need to report gains and losses on the assets being distributed to the shareholders. That is not true generally in the case of a partnership, which just carries over the basis from the partner's interests. Partnership interest carries over into the assets being received. In other words, deferring the gain or the loss. So if you have an appreciated asset that you want to put into a corporation or partnership, usually you probably should choose a partnership because eventually if you do make a distribution of that asset out of the business, generally tax deferred, for a partnership, but taxable if it's coming from a corporation, be it a C or an S. Okay, that's the main tax um, benefits or limitations. Now, uh, the main purpose of forming a business in one of these entities that's a non-tax purpose is to reduce the liability of the owner. Okay, so that's true in the case of a C corporation or an S corporation, but not true generally for a general partnership. And is true, you can limit the liability of by using a limited liability company, an LLC. Okay, that's the main non-tax purpose of using these types of entities. Let's compare um, the C-type corporation and an S-type corporation and a partnership. We can also assume this partnership could be limited liability companies that default to be a partnership for tax purposes. And the owners, of course, of a corporation would be the shareholders. And that's also true, be it an S or a C type, shareholders. And here is partners. You gotta have at least one partner, excuse me, at least two partners in a partnership. Yeah. In the case of corporations, you can have minimum one shareholder. Yeah, one shareholder, or thousands of shareholders. Although not true in the case of S corporation, we'll see you're limited to 100 shareholders. In fact, sometimes the letter S kind of refers to being a small business corporation. Okay, so now let's say that the corporation has income, so it's going to pay taxes to the government, both federal and state income taxes. Not true for S corporation, not true for the partnership. It's the shareholders that are going to pay the taxes, report their share of the corporation, S corporation's income and losses. Same thing with a partner. They pay the taxes for the business or also reap the benefits of deducting partnership losses. Okay, so now when we make distributions from the business to the owners, of course, we call that, in the case of a corporate distribution, it's a dividend. And now this is going to be taxable to the shareholder, not deductible by the C corporation paying out the dividend. So there's your double taxation when you have a C corporation. Tax once at the corporate level and again at the shareholder level when the profits are distributed to the owner. Now, in the case of an S corporation, when it pays out a dividend, this dividend is going to be tax free up to the extent we'll see the shareholder or shareholders have a basis in their stock investment. Okay, there's always exceptions again to this general rule I'm talking about, but generally the dividend here is tax free. So there you avoid the double taxation. Tax only one time at the shareholder level and not at the corporate level, and not again when you make a dividend distribution to the shareholder. In the case of a partnership, there's no tax here at the partnership level, but the partners pay a tax. And when you make a distribution or withdrawal to the partner, that distribution is tax-free to the extent of the partner's basis in his or her partnership interests. Okay, so again, tax-free here, avoiding that double taxation, only paying tax at the partner level one time. So in the case of now forming a S corporation, the same rules we saw back for the C corporation still apply. If you remember that section 351, tax deferred or tax free incorporation. Okay, so the substitute basis of whatever is being contributed will now substitute for the stock investment in the corporation. Okay, so that's simple if all we're dealing with is a cash contribution. The number of shareholders we're limited, I mentioned, to 100. Used to be much smaller in years gone by. And also, when you count this 100 number, you can count families as just usually one shareholder. So typically, closely held corporations, there's no problem meeting this 100 shares. Now, the type of shareholder you can have, definitely individuals like you and me would qualify. Also, certain types of trusts or estates may qualify as shareholders that can have S corporation stock. A type of shareholder that cannot be a S corporation shareholder would be a C type corporation, would be a partnership. If you have them as a shareholder for a corporation, our corporation cannot elect to be an S type. It will default to a C type corporation. Um, Here, types of corporations. I guess insurance companies, maybe financial institutions will not qualify for S type treatment. Classes of stock. Of course, if you have only one class of stock, that class of stock will be common stock. Now, you can have maybe different classes of common stock. One with voting rights, and the other one is non-voting. So typically, if you want to keep your stock within the family, but you don't want to give those young kids a voice in the management, then maybe you want to give those people non-voting shares. Now, voting and non-voting can need to choose to be an S type. Maybe that's the only thing non-voting shareholders can do. They can elect with the others to be an S type or remain a C type corporation. So to be an S type corporation, you gotta be a corporation. Again, you usually go to the state government. In the case of Hawaii, it's the Department of Commerce and Consumer Affairs, and you're registering your corporation, filing your incorporation paperwork, but that doesn't automatically make you an S type. By default, you're going to be a C type corporation unless you file an election form with the IRS, and it's going to be effective for the next year that's going to start. Unless if you want it to be effective for the current year, and we're assuming that, let's say you're using a calendar year, you have to make the election by March 15th into the current year, 2.5 months into the current year. If you make an election after this date, the S election is going to be effective next year. So now for the current year, you're still a C type versus an S type corporation. Here's the form 2553 that you have to file with the IRS to become an S type corporation. So if you're just forming a new corporation and you already know that you want to be an S type, it can be effective at the very beginning of the year. But again, you gotta make sure this form is filed with the IRS by 2.5 months into your year. Otherwise, the S election will start next year. Most corporations also have to use, S corporations have to use a calendar year. So if you elect to be an S corporation, you also can, I guess, unelect or terminate your S collection. To be an S corporation, all the current shareholders have to agree to be an S corporation. In fact, this Form 2553 requires all the current shareholders to sign off agreeing the corporation will be an S corporation. And of course, the main reason why they want everyone to be given notice is because they're going to have to report their share of the S corporation's income on their personal income tax return. So if you want to not be an S corporation anymore, more than half of the owners that own more than 50% of the stock have to file a statement with the IRS saying that we want to stop our S election as of that date or a future date. You can probably pick any date from that point forward. Yeah, so it doesn't have to be at the end of the year or beginning of the next year to terminate your election. So that's voluntary, where the shareholders choose to stop the S treatment. Now, it's possible to have an automatic termination, an invalid termination, if you don't meet the requirements mentioned in the past screen. For example, these requirements here, like you go over 100 shareholders, you have more than one class of stock. And we'll see some others here. If you have something called excessive passive investment income, where it exceeds 25% of your gross income for more than for the past 3 years, um, and you have something called retained earnings classified as earnings and profits. A lot of different requirements for this termination. And let's see, and you can choose, and it's going to be effective from whenever this happens, whenever this termination requirements are met. And from that point forward, now the corporation is going to be a C-type corporation, and again, maybe subject to double taxation. So if you're a C-type corporation and then you make an S election, from that point forward, now you may have a short year, or at least that point backwards, the C corporation has less than 12 months. And now the S corporation may choose a new year end, or keep the same year end, but it's going to possibly have less than 12 months also. So that's the last year of the C corporation, and the first year of the S corporation being less than 12 months or a short year. How do we allocate now income between the S and the C corporation? If you're looking at a whole 12-month period, you may need to divide that 12 months between the C type and the S type. And here it says you can use a daily method. Now we'll look at the amount of days in a year, 365, and how much of that falls within the C type and how much falls within the S type. And you just use a fraction and divide up the income and expenses between the two based upon the number of days. Or here's another method. The slide calls it specific identification method. Most practitioners say we're going to do a cutoff right here, close our books, and measure the income and expenses when you have a C, and then prepare a financial statement at that point so we know the profit and loss for the C corporation. And then the very next day we start up the S corporation's records, recording revenue and expenses from that point forward. Okay, so we don't keep track of days here, we keep track of the specific income and expenses earned and incurred in each period. The tax return due, probably we're going to follow the same due date as the original corporation for that 12-month period if he's kept on going, and then file both the short period here, at the same time, assuming you had a regular 12-month period. And you can also file extensions, like an automatic 6-month extension. If for some reason your S election gets terminated, you cannot choose or elect to be an S corporation again until 4 years have passed. Here you can start off in the 5th year. The IRS may give you permission to get an earlier S election in effect if for some reason maybe some kind of mistake was made and not really to terminate it on purpose for saving taxes. So if you're forming a new corporation, we know back in the past chapters, you can just make whatever election to choose the method of accounting, be it cash or accrue or a combination of both. And you can pick your year end. But again, most S corporations have to use a calendar year end, December 31st. Now, if you're dealing already with an existing C corporation and you're now electing to be an S corporation, what you're going to do is use the same method of accounting that was used in the C corporation for the S corporation. So the way we're going to now avoid double taxation is to pass through to the shareholders the corporation's income and losses and what we call separately stated items like we had seen back in the partnership chapters. And if the same shareholders own the same number of shares throughout the whole year, there's no problem. We just allocate these items based upon the amount of shares they have. But if shareholders change during the year, or if the number of shares each shareholder has changes during the year, now that's going to give us a little bit more challenging allocation to do among the shareholders. Here we're going to look at each day the shareholder has owned stock in the corporation. And then by the end of the year, we allocate all of the income expenses depending upon how many days and how many shares they had owned during the year. Or we can go to that cutoff method like we've seen before, the specific period method. Here's an example. We have our CCS Cooperation that we've been dealing with for the past few chapters. And we have a profit of $365,000 for the whole calendar year that we're going to divide up among three shareholders, Nicole, Sarah, and Chance. Each of them own 1/3 of the shares of outstanding stock, common stock in this corporation. So if they've held their shares evenly throughout the whole year, all we would do is divide up this 365 by 3. But we're told that Chance is going to sell his stock to Nicole on this date here, June 14th. So Chance is a shareholder for 165 days during the year. And Nicole and Sarah are shareholders for the whole year, but Nicole's shares have increased for the last part of the year, this last 200 days. So what you can do, let's take a look at the solution here. Remember, the person that has the straight 1/3 interest for the whole year is Sarah. So if you divide that 365,000 by 3, 1/3, you'll get her share of the S corporation's income she has to report. Now, Chance, his 1/3 interest stops after, I think it's 200 days, 165 days. So you're going to take this amount, and that's what Chance would have also if he held it for the whole year. But he had it only for 165 days out of 365. So if you multiply this fraction times the 1/3 share, what you'll get is the amount he has to report of the S corporation's income for the year. And Nicole, her share would be this amount here, included in this 188, plus what Chance is not reporting. In other words, the rest of this amount here goes into Nicole's share. So you can do it by, again, using fractions and multiplying it by the number of shares and timesing it by the 365,000 to get all of this, but I'm just showing you a summary of how they got this solution here. Another way of calculating the allocation of income and loss among the shareholders is if all three shareholders agree to use this amount for the first part of the year, the 165 days, and divide it equally among the three shareholders. And then the rest of the income, again, you got to close your books here at the end of this June 14th and open it up again on June 15th to figure out these two amounts here. And this 265,000 is now going to be allocated among Nicole and Sarah. 2/3 of this would go to Sarah, and 1/3 would go to 2/3 to Nicole and 1/3 to Sarah, because they're the only two shareholders at the end of the year with those proportions, 2/3 to Nicole and 1/3 to Sarah. and you add up all their shares. Yeah, could be different than the solution you see here, but again, all three shareholders have to agree to that method. Otherwise, you use the daily method illustrated on this screen. The reporting requirements, we saw that an 1120 form was used for a C type, but there is a special type, S 1120S, for an S type corporation. But just like a partnership, there's going to be a Schedule K showing a summary of all of the income and deductions and credits that have to be allocated among not the partners but now the S corporation shareholders. And then the detail that goes to each shareholder will be on a Schedule K1. Again, Schedule K is summarizing the whole corporation, and K1 has to be prepared for each shareholder for the year. And the reason why we need that detailed K1 is because the income or losses, revenue, expenses have to be, just like a partnership, grouped into the net ordinary business income or loss. Remember, that's the main profit or loss of the business. And then the separately stated items, that's the detailed revenue or expenses that could have separate tax treatment or different tax treatment, not at the corporate level, but at the owner shareholder level. So here's some examples of separately stated items, and this is pretty much a duplication of what we saw for a partnership's 1065 form. Remember, again, the Schedule K and K1. The only thing that's different on a partnerships one, possibly that you don't see here for an S corporation one, is that we do not have guaranteed payments. We'll talk about salaries going or wages going to a shareholder owner of S corporation. But here in the case of a partnership, remember that guaranteed payment treatment where it's going to be income to the receiving partner but a deduction to the whole partnership. Also, what you don't see here that you would see in the case of a partnership is self-employment income subject to self-employment tax or the Social Security Medicare tax. Distributions, income from a S corporation to a shareholder is not subject to self-employment tax. It's not subject to the Social Security Medicare tax. Now, if that shareholder is an employee, that could not be the case for a partner in a partnership. A shareholder, employee of a S corporation would be paid wages or salary, which is subject to the Social Security Medicare tax, both the employer and employee share. So no SE tax now in the case of a S corporation. Okay, so we'll see these items listed here also on Schedule K and K1. Here is our 1120S, pretty much like an 1065 for a partnership. You have the business income minusing the business deductions to get the ordinary business income or loss. Not all the income is listed here. Separately stated items go straight onto the Schedule K. You don't see all the deductions here. Separately stated items again go straight onto the Schedule K. Now this ordinary business income or loss, this amount here in line 21, is going to be the first dollar amount on that Schedule K. Here's that ordinary business income or loss that has to be allocated among all the shareholders of the S corporation. And here's the other different types of income separately stated for shareholders. Other deductions not reported back on page 1 of the 1120S, separately stated for shareholders. Same thing with credits. This goes on for another page or so. Again, separately stated items here on Schedule K. Now to report how much of these amounts here in this column is each shareholder's share, you have to prepare a Schedule K1 for each shareholder. Here's the name of the corporation, and here is the name of this one shareholder, and here is their share of the separately stated, well, definitely the proportion of the ordinary business income or loss, and then the separately stated items. This will probably go to a Schedule E for the individual shareholder, and then eventually transferred to a Schedule number 1, and eventually onto the 1040 group with the other income of the individual taxpayer. Let's stop here, and when we come back on part 2, we'll get into more detail of how to allocate income and deductions among the shareholders.